Hello everyone, welcome to Defense IAS Academy. Let us start the concept on the Indian economy. The concept is tax structure in India. What is tax? Modern economies defines tax as a mode of income redistribution. There might be other ways also to look at it. The usual meaning of tax, people think that a tax is imposed by a government to fulfill its important obligations on the expenditure front. Here, income looks redistribution from the consumption side. First one is the incidence of tax. The point where tax looks as being imposed is known as the incidence of tax, the event of tax imposition. Second is impact of tax. The point where tax makes its effect felt is known as the impact of tax, the after effect of tax imposition. Direct tax. The tax which has incidence and impact at the same point is the direct tax. The person who is hit, the same person bleeds. For example, income tax, interest tax, etc. Second one is the indirect tax. The tax which has incidence and impact at the different points is the indirect tax. The person who is hit does not bleed, someone else bleeds. As for example, excise, sales tax, etc., which are imposed on either the producers or the traders, but it is the general consumers who bear the burden of tax. In indirect tax, we can take an example. Whenever we go to a restaurant, a waiter gives us the bill. Under that, a tax is implied on a bill and we have to give the tax on the food we have eaten. That is a service tax, because they were providing us the services also. This is an example of indirect tax. Let us move further. Methods of taxation. First method of taxation is, we have three methods of taxation in economies. First method of taxation is progressive taxation. This method has increasing rates of tax for increasing value or volume on which the tax is being imposed. Indian income tax is a typical example of it. The idea here is less tax on the people who earn less and higher tax on the people who earn more. Classifying income earners into different slabs, being poor is rewarded while richness is punished. Taxpayers also start evading tax by showing lower income, unreal income. But from different angles, this tax is pro-poor and taxes people according to their affordability and sustainability. This is the most popular taxation method in the world and a populist one too. This method is believed to discourage more earnings by the individual to support low growth and development unintentionally. Now the second one is the regressive taxation. This is just opposite to the progressive method, having decreasing rates of tax for increasing value of volume on which the tax is being imposed. There are not any permanent or specific sectors for such taxes. As a provision of promotion, some sectors might be imposed with regressive tax. As for example, to promote the growth and development of small-scale industries, India at one time had regressive excise duty on their productions. With increasing slabs of volume they produced, the burden of tax used to go on decreasing. This method, while appreciated for rewarding the higher producers or income earners, is criticized for being more taxing on the poor and low producers. Next is the method of taxation is proportional taxation. In such a taxation method, there is neither progression nor regression from the point of view rate of taxes point of view. Such taxes have fixed rates for every level of income or production. They are neutral from the poor or rich point of view and or from the point of view of the levels of production. Usually this is not used by the economies as an independent method of taxation. This method is used as a complementary method with either progressive or regressive taxation. If not converted into proportional taxes, every progressive tax will go on increasing and similarly every regressive tax will decrease to zero, becoming completely a futile tax method. Means it will become a completely futile tax method. Our next topic under the concept of tax structure in India is a good tax system. There is a broad census of 5 principles of a good tax system among economists and the policymakers. First one is the fairness. Though fairness is not always easy to define, economists suggest inclusion of 2 elements in the tax system to make it fair, namely horizontal equity and vertical equity. Individuals in identical or similar situations paying identical or similar taxes is known as horizontal equity. When better off people pay more taxes, it is known as vertical equity. Second one is the efficiency. Efficiency of a tax system is its potential to affect or interfere the efficiency of the economy. A good tax system raises revenue with the least cost of the taxpayers and least interference on the allocation of resources in the economy. The tax system affects the economic decisions of individuals and groups by their encouraging or discouraging them to save, spend, invest, etc. Taxes can improve efficiency of the economy. Taxes on pollution or on smoking give revenue to the government and serves broader social purposes too. This is known as the double dividend of a tax. Third one is the administrative simplicity. This is the third criterion, which includes factors like computation, filing, collection, etc. of the taxes, that all should be as simple as possible. Simplicity checks tax evasion too. Tax reform in India has simplification of tax as its major plank, also recommended by the Chiliaha Committee. Let us move further. Fourth one is the flexibility. A good tax system has the slope of desirable modification in it if there is any such need. Fifth one and the last one is the transparency. How much taxpayers are actually paying and what are they getting against it in the form of the public services should be ascertainable. That is the transparency factor. Next topic under this concept is methods of expenditure. Similar to the methods of taxation, the modes of government expenditure are also of 3 types: progressive, regressive and proportional. The best way of taxation is progressive and the best way of government expenditure is also progressive. And they suit each other beautifully. Most of the economies around the world are having progressive taxation with progressive expenditure. At the first instance, it seems that as a country achieves better levels of development, sectoral and the item-wise expenditure of the country must have decreasing trends. But practical experience shows that the level of expenditure needs enhancements every day and economy always needs more and more revenues to fulfill the rising expenditures. That is why for economies the best form of government expenditure is the progressive expenditure. Next one is the topic is value added tax, or we may call it as VAT. The value added tax is a method of tax collection as well as a name of a state level tax. At present in India, a tax collected at every stage of the value addition, that is either by production or distribution, is known as a value added tax or VAT. The name itself suggests that this tax is collected on the value addition, that is production. Need of VAT in India. Over 150 nations in the world have implemented the VAT system of taxation regarding collecting their indirect taxes. There have been valid reasons why India should move towards the VAT method of tax collection. Implementation exercise of VAT. The implementation exercise of VAT in India has been very encouraging. The new tax system has been received well by all the stakeholders, the transition being quite smooth. The revenue performance of VAT implementing states UTs, that is 25, has been encouraging. The tax revenue registered an increase of 13.8% over the annual growth rate of the last 5 years. Only 8 states claimed, there is no 17, that is a mistaken. I'm so sorry for this. Only states claimed for VAT compensation from the center in 2005 to 2016, which come down to only 5 in the fiscal of 2006 and 7. Next topic says Goods and Services Tax. The Goods and Services Tax, or we may call it as GST, is a tax proposal in India which will emerge after merging many of the state and central level indirect taxes. Important points of the proposed GST are as follows. It will be a tax collected on the VAT method, having all the benefits of a VAT kind of tax. Second, it will be imposed all over the country with the uniformity of rate and will replace multiple central and state taxes. A single VAT it will be known. The taxes to be withdrawn or merged into the GST are central taxes, that is CENVAT and VAT, service tax, sales tax and stamp duty. State tax, state excises, state excise, sales tax, entry tax, lease tax, works, contract tax, luxury tax, octroi, turnover tax and cess. Under GST, the third point is the proposed tax has a single rate of 20% of its center and state will have a share of 12% and 8% respectively. Additional excise duty. There is a tax in India known as the additional excise duty imposed and collected by the center. Basically, this is not a form of excise duty at the same, though the center collects it, the total corpus of collected tax is handed over to the states. Next is the CST reform. CST stands for Central Sale Tax. The Central Sale Tax being an origin based on non-rebatable tax, it is generally agreed is inconsistent with the concept of VAT. That is why it needs to be phased out. The CST reforms is a part of the tax reforms in India. The critical issue involved in phasing out of is that of compensating the states for revenue losses on account of such a phase out. Since phasing out of CST will entail a revenue loss, states have been insisting on a mechanism to compensate them on a permanent basis. The 4% rate of CST has to be phased out in stages with 1% phase out in one financial year and the states duly compensated through tax devolution. Because of phasing out, it is now at 2%. Next topic is service tax. The share of the services sector in the GDP of India has been going upward for the last decade. The introduction of service tax in 1994 and 95 by the Government of India has started paying the government on its tax revenue front. Introduced to redress the asymmetric and the distortionary treatment of goods and services in the tax regime, the service tax has seen gradual expansion in the country. Next topic is Commodities Transaction. The Union Budget 2013 and 14 has introduced the Commodities Transaction Tax, or we may call it as CTT. However, only for non-agriculture commodity futures at the rate of 0.01%. Along with this, transactions in commodity derivatives have been declared to be made non-speculative and hence for traders in the commodity derivative segment. Any losses arising from such transactions can be set off against income from any other source. Next topic is Securities Transaction Tax. The Securities Transaction Tax is a type of financial transaction tax levied in India on transactions done on the domestic stock exchanges. The rates of STT, that is Securities Transaction Tax, are prescribed by the central government through its budget from time to time. In tax parlance, this is categorized as a direct tax. The tax came into effect from 1st October 2004. In India, STT is collected for the Government of India by the stock exchanges. With charging of STT, long-term capital gain tax was made zero and short-term capital gain tax was reduced to 10%. Next topic is Capital Gains Tax. This is a direct tax and applies on the sales of all assets if a profit or gain has been made by the owner of the asset. A tax on the gains one gets by selling assets, and the tax has been classified into two. First one is the short-term capital gain, we name it as Ltcg, and the second one is the long-term capital gain, that is Ltcg. Let me explain you the short-term capital gains and the long-term capital gains. First one is the short-term capital gain. It applies if the asset has been sold within 36 months of owing it. In this case, the rate of this tax is similar to the normal income tax slabs, but the period becomes 12 months in cases of shares, mutual funds, units of the UTI and the zero coupon bond. In this case, the rate of this tax is 15%. Let us move further towards the second type of capital gain, that is the long-term capital gain, Ltcg. It applies if the asset has been sold after 36 months of owning it. In this case, the rate of this tax is 20%. In cases of shares, mutual funds, units of UTI and zero coupon bond, there is exemption from this tax. Next topic under this concept is minimum alternate tax, or we may name it as MAT. It is a direct tax imposed on the zero tax companies at the rate of 18.5% on their book profit. This was first imposed in 1997 and 1998. Next is investment allowance. Announced in the Union Budget 2013 and 14, a tax break given to companies for high value investment in plant and machineries, over and above depreciation benefits enjoyed by them. A company investing rupees 100 crore or more in plant and machinery during the April 2013 to March 2013 will be entitled to deduct an investment allowance of 15% of the investment. This is expected to see enormous spill-over benefits to some small and medium enterprises. The proposed investments allowance scheme should be seen a drain on the government's tax collections. It may be seen as a kind of tax exemptions. Let us move further. Next is the tax expenditure. As per the current economic survey 2014 and 15, there is significant divergence in India between the official rates of taxes and the actual or effective rate of taxation. This arises on account of exemptions to the tax rate. As indicated earlier in the section on collection rates, the magnitude of revenue foregone is indeed high. In case of direct taxes, the situation prevails as given below. First, the tax foregone on account of exemptions under corporate income tax for 2013 to 14 was estimated at rupees 76,116 crore. In this case, deduction on account of accelerated depreciation, deduction for export profits of export-oriented units located in specific economic zones, and profit of businesses in the power and telecom sectors were some of the major incentives. Tax foregone on account of exemptions under personal economic tax for individual taxpayers was estimated at rupees 40,414 crore in 2013 and 14. In this case, the bulk of the revenue foregone was on account of the exemption given for certain investments and payments under Section 80C of the Income Tax Act. That is why now the important thing is that in so far as indirect taxes are concerned, revenue foregone is defined as the difference between the duty that would have been payable but for the issue of exemption notification and actual duty paid in terms of relevant notification. This situation stands as given below. The revenue foregone for the financial year 2013 and 14 in respect of excise duties is estimated at rupees 1,93,679 crore, including rupees 12,880 crore on account of area-based exemptions. Second one, duty foregone for the year 2013 and 14 on account of all the exemption notifications on custom was estimated at rupees 2,60,714 crore. This was all about the concept of tax structure in India. If you like, please subscribe. Welcome to Defense IAS Academy. Now our topic is Public Finance in India. Introduction. Let me introduce you. So introduction for this concept is public finance is a much wider title which includes all those matters which are connected with public money, the money a government gets, spends, borrows, lends, raises or prints. Public finance, that is finances of the government, now named as public economies. And topic under this concept, public finance in India, is budget. An annual financial statement of income and expenditure is generally used for a government, but it could be of a firm, company, corporation, etc. The word has its own origin in the British parliamentary exercise of preparing such statement way back in the mid-18th century from the French word baguette, meaning a leather bag, out of which the financial statement was brought out and presented in the parliament. Today, this word is used to mean the annual statement in all economies around the world. The Constitution of India has a provision for such a document called Annual Financial Statement to be presented in Parliament before the commencement of every new fiscal year. It is also known as the Union Budget. Let us move further. Data in the budget. The Union Budget has three sets of data for every concerned sector or subsector of the economy. First one is the actual data of the preceding year. Here preceding year means 1 year before the year in which the budget is being presented. Suppose the budget presented is for the year 2008 and 9. The budget will give the final and actual data for the year 2006 and 7. Because the budget is presented in February end of financial year 2007 and 8. After the data, either we write A means actual data, final data, or write nothing. Second one is the provisional data of the current year. Third is the budgetary estimates for the following year. There are such three other kinds of data. First one is the revised estimate. Second one is the quick estimate. Third one is the advanced estimate. Let us read or understand the meaning of these three types of kind of data. First one is the revised estimate. Revised estimate is basically a current estimation of either the budgetary estimates or the provisional estimates. It shows the contemporary situation. It is an interim data. Second one is the quick estimate. Quick estimate is a kind of revised estimate which shows the most latest situation and is useful in the process of going for future projections for some sector or subsector. It is an interim data. Third one is the advanced estimate. Advanced estimate is a kind of quick estimate that but done ahead, or we can say in advance of the final stage when data should have been collected. It is also an interim data. Next topic is development and non-development expenditure. Total expenditure incurred by the government is classified into two segments, that is the developmental and the non-developmental. All expenditures of productive nature are developmental, such as on the heads of new factories, dams, bridges, roads, railways, etc. All investments. The expenditures which are of consumptive kind or do not involve any production are non-developmental. That is paying salaries, pensions, interest payments, subsidies, defense expenses, etc. Next topic is plan on and non-plan expenditure. Every expenditure incurred on the public exchequer is classified into two categories, the plan and the non-plan. All those expenditures which are done in India in the name of planning is the plan expenditure, and rest of all are non-plan expenditure. Basically, all asset creating and productive expenditures are planned, and all consumptive and non-productive, non-asset building are non-plan expenditures, and are developmental and non-developmental expenditure respectively. Let us move further. Next topic is revenue. Every form of money generation in the nature of income earnings are revenue for a firm or a government which do not increase financial liabilities of the government. That is the tax incomes, non-tax incomes along with the foreign grants. Next is the non-revenue. Every form of money generation which is not income or earnings for a firm or a government, that is money raised via borrowings, is considered a non-revenue source if they increase financial liabilities. Next is receipts. We don't call it as receipts, it is receipts. P is silent. Every receiving or accrual of money to a government by revenue or non-revenue sources is a receipt. Their money is also called total receipts. Their sum is also called total receipts. It includes all incomes as well as non-income accruals of a government. Let us move further. Revenue receipts. Revenue receipts of a government are of two types or kinds. Tax revenue receipts and non-tax revenue receipts, consisting of the following income receipts in India. First one is the tax revenue receipt. This includes all money earned by the government via the different taxes the government collects, that is all direct and indirect collections. Another revenue receipt is the non-tax revenue receipts. This includes all money earned by the government from sources other than taxes. In India, they are profits and dividends which the government gets from its public sector undertakings. Interest received by the government out of the loans forwarded by it, be it inside the country, that is internal lending, or outside the country, that is external lending. It means this income might be in both domestic and foreign countries. Third one is the fiscal services also generate incomes for the government, that is currency printing, stamp printing, coinage and medals minting, etc. Fourth one is the general services also earn money for the government as the power distribution, irrigation, banking, insurance, community services, etc. Fifth one is the fees, penalties and fines received by the government. Sixth one is the grants which the government receives. It is always external in the case of central government and internal in the case of state governments. Next topic is revenue expenditure. All expenditures incurred by the government are either of revenue kind or current kind or compulsive kind. The basic identity of such expenditures is that they are of consumptive kind and do not involve creation of productive assets. They are either used in running of a productive process or running a government. A broad category of things that fall under such expenditures in India are: first one is the interest payment by the government on the internal and external loans. Second one is the salaries, pensions and provident fund paid by the government to government employees. Third one is the subsidies forwarded to all sectors by the government. Fourth one is the defense expenditures by the government. Fifth is the postal deficits of the government. Sixth is the law and order expenditures, that is police and parliamentary. Seventh one is the expenditures on social services, which includes all social sector expenditures as education, healthcare, social security, poverty alleviation, etc. and general services, tax collection, etc. Eighth one is the grants given by the government to Indian states and foreign countries. Next topic is revenue deficit. If the balance of total revenue receipts and the total revenue expenditures turns out to be negative, it is known as the revenue deficit. A new fiscal terminology used since the fiscal 1997 and 98 in India, revenue deficit may be shown in the quantitative form. Our next topic is effective revenue deficit, or we may call it as ERD. It is a new term introduced in the Union Budget 2011 and 12. Conventionally, revenue deficit is the difference between revenue receipts and the revenue expenditures. Here revenue expenditures includes all the grants which the union government gives to the state governments and the UTs, some of which create assets. According to the Finance Ministry, such revenue expenditures contribute to the growth in the economy and therefore should not be treated as unproductive in nature, like other items in the revenue expenditures. And on this logic, a new methodology was introduced to capture the effective revenue deficit, which is the revenue deficit excluding those revenue expenditures. Our next topic is revenue budget. The part of the budget which deals with the income and expenditure of revenue by the government. This represents the annual financial statement of the total revenue receipts and the total revenue expenditure. If the balance emerges to be positive, it is a revenue surplus budget. And if it comes out to be negative, it is a revenue deficit budget. Next topic is capital budget. The part of the budget which deals with the receipts and expenditures of the capital by the government. This shows the means by which the capital is managed and the areas where capital is spent. Next topic is capital receipts. All known revenue receipts of a government are known as capital receipts. Such receipts are for investment purposes and supposed to be spent on plan developed by a government. But the receipts might need their diversion to meet other needs to take care of the rising revenue expenditure of a government, as the case had been with India. We can also add on the capital receipts in India include the following capital kind of accruals to the government. First one is the loan recovery. Second one is the borrowings by the government. Third one is the other receipts by the government. Next topic is capital expenditure. All the areas which get capital from the government are part of the capital expenditure. It includes many of the heads in India. First one is the loan disbursal by the government, loan repayments by the government of the borrowings made in the past. Third one is the planned expenditure of the government. Fourth one is the capital expenditures on defense by the government. Fifth one is the general services. Sixth one is the general liabilities of the government. Let us move further. Next is the capital deficit. There is no such term in public finance or in economics as such, but in practice one usually hears the use of the term capital crunch, scarcity of capital in day-to-day economic news terms. Basically, the government in the news is facing the problem of managing as much funds, money, capital as is required by it for public expenditure. Such expenditure might be of revenue kind or capital kind. Such difficulties have always been with the developing economies due to their high level requirement of capital expenditures. Had there been a term to show this situation, it would naturally have been capital deficit. Next topic is the fiscal deficit. When balance of the government's total receipt, that is revenue plus capital receipts, and the total expenditure, that is revenue plus capital expenditures, turns out to be negative, it shows situation of the fiscal deficit. A concept being used since the fiscal 1997 to 1998 in India. The situation of fiscal deficit indicates that the government is spending beyond its means. To be more simple, we may say that the government is spending more than its income. We can also say fiscal deficit may be shown in the quantitative form. Next is the deficit and surplus budget. Sorry. It is again, we can say fiscal deficit is a concept, is more in broader concept. It is a broader concept. First is the primary deficit. The fiscal deficit excluding the interest liabilities for a year is the primary deficit, a term India started using since the fiscal 1997 and 98. It shows the fiscal deficit for the year in which the economy had not to fulfill any interest payments on the different loans and liability which it is obliged to, shown both in quantitative and percentage of GDP forms. Second one is the monetized deficit, the part of the fiscal deficit which was provided by the RBI to the government in a particular year in monetized deficit. This is a new term adopted since 1997 and 98 in India. This is shown in both the terms in quantitative as well as a percentage of GDP for that particular financial year. Let us move further towards the new topic. Now we are going to discuss this new topic, that is a deficit and surplus budget. When the budgetary proposals of a government for a particular year processes higher expenditures than the receipts, it is known as a deficit budget. Opposite to this, if the budget proposes lesser expenditure than the receipt, then it is termed as a surplus budget. Our next term is deficit financing. The act or process of financing or supporting a deficit budget by a government is deficit financing. In this process, the government knows well in advance that its total expenditures are going to turn out to be more than its total receipts and enacts or follows such financial policies so that it can sustain the burden of the deficits proposed by it. Need of deficit financing. It was in the late 1980s that the idea and the need of deficit financing was felt. It is when government needs to spend more money than it was expecting to earn or generate in a particular period to go for a desired level of growth and development. Means of deficit financing. Once deficit financing became an established part of public finance around the world, the means of going for it were also evolved by that time. This means basically are the ways in which the government may utilize the amount of money created as the deficit to sustain its budget for developmental or political needs. Let us move further. Next term is fiscal policy. The real meaning, significance and impact of fiscal policy emerged in the wake of the Great Depression and the Second World War. Fiscal policy has been defined as the policy to the government with regard to the level of government purchases, the level of transfer and the tax structure. Probably the best and the most acclaimed definition among experts. Later, the impact of fiscal policy and macroeconomy was beautifully analyzed. As the policy has a deep impact on the overall performance of the economy, fiscal policy is also defined as the policy which handles public expenditure and tax to direct and stimulate the level of economic activity. We can also add on, fiscal policy is also defined as changes in government expenditures and taxes that are designed to achieve macroeconomic policy goals. Therefore, we can say that fiscal policy denotes the use of taxes in government expenditures. Next topic is limiting government expenditure. Elected governments are composed of different interest groups and lobbies. At times, such governments might intend to use its economic policies in a highly populist way for greater political mileage without caring for the national exchequer. Such acts might force the governments to go in for excessive internal and external borrowing and printing of currency. Governments generally avoid to increase tax or impose new taxes for their revenue increase. As such, acts are politically unpopular. On the other hand, borrowings and printing of currency impose on no immediate economic or political cost. A government in the election year usually spends money frugally by borrowings from the RBI in India because it is the coming of government after the elections who is supposed to repay them. Government expenditures remain higher and expanding due to some economic reasons also. By doing so, extra employment is generated and the output means GDP of the economy is also boosted. Our next topic is fiscal consolidation in India. Deficits of the center and states after 1973 had been above 10% of the GDP till 2000 and 2001. More than half of it had been due to huge revenue deficits. The governments were cautioned by the RBI, the Planning Commission as well as by the IMF and the WB about the unsustainability of the fiscal deficit. It was at the behest of the IMF and the IMF that India started the politically and socially painful process of fiscal reforms, a step towards fiscal consolidation. A number of steps were taken by the government at the center in this direction, and there had been insistent attempts to do the same in the state's public finances too. Major highlights in this direction can be summed up as given below. First one is the policy initiatives towards cutting revenue deficits. First one is the cutting down expenditure such as burden of salaries, subsidies, interest burden, postal deficits, etc. Second one is the increasing revenue receipts. Second main point is the borrowing program of the government, and the third point is the fiscal responsibility on the governments. Next topic is zero-based budgeting. The idea of zero-based budgeting first came to the privately owned organization of the USA by the 1960s. This basically belonged to a long list of guidelines for managerial excellence and the success. Others being management of objectives, metrics, management, portfolio management, etc. to name a few. Zero-based budgeting is the allocation of resources to agencies based on periodic re-evaluation by those agencies of the need for all the programs for which they are responsible, justifying the continuance or termination of each program in the agency budget proposal. In other words, an agency reassesses what it is doing from top to bottom from a hypothetical zero base. We have three essential questions which must be answered objectively before going for any expenditures as per the techniques of zero-based budgeting. First one is the should we spend, second how much should we spend, and third one is the where should we spend. These are the first main three questions which are arising. Our next topic is results framework document. Results framework document provides a summary of the most important results that an organization expects to achieve during the financial year. The document has two main purposes. First one is to move the focus of the organization from process orientation to results orientation. And the second one is to provide an objective and fair basis to evaluate the organization overall performance at the year end. The result framework document guidelines are divided into three basic sections. First one is the format of result frame document. Second one is the methodology for evaluation, and third one is the result framework document process and timelines. Next is the charged expenditure. It is the public expenditure which is beyond the voting power of the parliament and is directly withdrawn from the consolidated fund of India. The emoluments of the President, Speaker and the Deputy Speaker of the Lok Sabha, Chairman and the Deputy Chairman of the Rajya Sabha, Judges of the Supreme Court and the High Courts, etc. in India. Next is types of budgets. Golden rule. The proposition that a government should borrow only to invest and not to finance current spending is known as the golden rule for public finance. This rule is undoubtedly prudent, but provided spending is honestly described as investment, investments are efficient and does not crowd out the important private sector investments. Next is the balanced budget. A budget is said to be a balanced budget when the total public sector spending equal total government income during the same period from taxes and charges for public services. In other terms, a budget with zero revenue deficit is balanced budget. Such budget making is popularly known as a balanced budgeting. Second one is the gender budgeting. A gender budget by the government which allocates funds and responsibilities on the basis of the gender is known as the gender budgeting. It sees whether it is a male or female. It is done in an economy where socio-economic disparities are chronic and clearly visible on a sex basis. Next topic is Treasury computerization of state government. A scheme for implementation of the mission mode project, computerization of the state treasuries was put in place by the Government of India in June 2010 under the National Government's Plan. The states and the UTs are required to complete their projects in about 3 years beginning 2010 and 11. The funds are released against the deliverables. The scheme will support states and UTs to fill the existing gaps in their treasury computerization, upgradation, expansion and interference requirements. Apart from supporting basic computerization, the scheme covers installation of suitable hardware and application software systems in a network environment on a wide area basis and building of interfaces for data sharing among various stakeholders. Let us move further. Next topic under this concept is public finance in India is direct benefit transfer. The DBT plan was introduced on January 1, 2013 with 7 schemes in 20 districts. India has embarked on a DBT scheme in selected districts wherein it has been envisaged that benefits such as scholarships, pensions and Mahatma Gandhi National Rural Employment Guarantee Act. This will be known, in short we will call as MGNREGA. Wages will be directly credited to the bank or the post office accounts of identified beneficiaries. The direct benefit transfer scheme will not substitute entirely for delivery of public services. For now, it will replace neither food and kerosene subsidies under the TPDS nor fertilizer subsidies. It is designed to The direct benefit transfer is designed to improve budgeting, reduce corruption, eliminate waste, control expenditure, and the last one is the facilitate reforms. This is all about the topic public finance in India. Hope you like it. If you like it, please subscribe. Please understand this, try to understand this topic. This is a very interesting topic and this is all about it. Thank you.